Hi all, welcome to this tutorial. In this tutorial, we are going to cover profitability ratios. As we know, the profitability ratios are the important ratios in the profitability analysis to see how is the performance of a company, especially in terms of profitability, controlling cost, generating revenue, and maintaining that pricing power and maintaining profitability for the product, maintaining right product mix. The profitability ratio is telling you that a lot of things about the company regarding its performance, its profitability, its cost control, and more. So just moving to profitability ratios. As in the profitability ratios, what it is trying to tell that how much you will make as a profit if you made a certain amount of sales. Profitability ratios are not telling about the how much sales or how much profit you make. It is telling how much you will generate as profit if you made certain percentage of sales. For an example, if you made a sale of $100,000, the profitability ratios will tell you how much you will maintain the profit from this out of this $100,000. Obviously, there are different layers for the profitabilities like the GP level, that is gross profit ratio, then the operating profit, then the net profit, then EBITDA. There are different layers for the profit. So the profitability ratios are trying to tell what will be our remaining profit in the company once you made a certain amount of sales. So let's move into the first profitability ratios, that is GP margin or gross profit margin percent. It is a key indicator of a company manufacturing or pricing ability or its purchasing ability. It measures the percentage of revenue remaining after subtracting the cost of goods sold. This margin reflects the profitability of a company's core product or service before considering operating expenses. So the GP, as we know, the GP, gross profit, means cost of goods sales minus cost of goods sold. This is our gross profit, cost of goods sold. So this is the gross profit. In the gross profit margin, what is trying to sell that it's connecting this GP with the sales, and it is trying to tell if you made $100 as sales, what will be your gross profit. Just assume if the gross profit margin is 30 for an instant or for an example, 30%, which indicate that if this company made a sale of $100, then its gross profit will be $30. It is trying to link that gross profit with the total sales or net revenue to see the relationship between the gross profit and the sales. So it is trying to tell if you made $100 as sales, what will be your gross profit? Or if you made whatever it is, 100,000 or 1 million, 10 million worth of sales, what will be your gross profit? That is the gross profit margin trying to tell. So obviously the formula for the gross profit margin is, the first one is GP minus GP divided by its sales or revenue. This is your gross profit margin. Obviously the higher ratios mean the companies have ability to generate more gross profit compared to its stage, is indicate its company's efficiency in production or has strong pricing power. Definitely the lower ratios will indicate, or it's a margin, it's an indicator for a company, it's increasing raw material cost or increasing purchase cost or higher labor cost or competition price in the forced to cut. So it is the first layer in the profit, gross profit, or in the gross profit margin, which is trying to tell how much remain as gross profit, how once we reduce the cost of goods sold from the sales. Let's look into this example. In this example, the revenue is 5 million and the cost of goods sold is 3 million. So in this case, the gross profit, obviously it is 5 million minus 3 million. That is 2 million. So the gross profit margin or GP ratio is 2 million divided by 5 million, that is 40%. So it indicates that if this company can generate a sale of whatever it is, if it is $100 for or every $1 of sales, the company retain 40% as gross profit, which can be used to cover its operating expenses and to provide net profit. So we'll conclude the gross profit now. It is the ratio which is telling what is the relationship between sales and the gross profit. And again, it is trying to sell what is remaining in the business or in the business after deducting cost of goods sold from the total sales. So let's move into next ratio or next margin, that is operating profit margin. The operating profit margin, again, it is similar to gross profit margin, but it is comparing the company's operating profit with the sales. In the gross profit margin, we are taking the gross profit, but when it's come to operating profit margin, we are coming to next layer, that is operating profit, and we are comparing this operating profit with the sales to see how is operating profit margin. Operating profit, also known as earning before interest and tax, it assesses a company's profitability from its core business operation. It measures the percentage of revenue remaining after covering both the cost of goods sold and operating expenses. As we told now, in the operating profit, it is the second layer. The first layer is gross profit, the second layer is operating profit. In the operating profit, it is covering all the operating expenses, which include the first thing, the cost of goods sold, then the selling, marketing, administration, all the operating expenses will cover in the operating margin. So the operating profit margin ratio will compare. It is comparing a company's operating profit with its sale to see how effectively the company is managing its operational expenses and also how company is retaining its GP percentage or GP ratio when compared with related to its sales and cost of goods sold. So let's see the formula for operating profit margin. The formula is operating profit divided by revenue. For example, if a company have revenue of 5 million, then the cost of goods sold is 3 million, then our GP is 2 million. Sorry, it's 2 million. If the company have another 500,000 in operating expenses, so the operating profit margin is 1.5 million in this case. So if you're comparing this 1.5 with this 5 million, then you will get the operating profit margin. So we look into this example. This example, the revenue is 5 million. You can see the revenue is 5 million and the gross profit is 2 million and our operating expenses is 1.2 million. So in this case, our operating profit or EBIT is 800,000. So to calculate the operating profit margin, we are comparing this operating profit with the sales to see the relationship and how healthily this company is maintaining its operating profit margin. Just in this example, so in this example, it is 800,000 divided by 5 million, that is 16%, which indicate that every $1 of sales, this company is maintaining 16 cents as a operating profit, or every $100 of sales, this company is retaining $16 as operating profit in the business. So as we know, if the operating profit margin is increasing, obviously it is good for the company, which is a symbol of profitability and its effectiveness in the pricing level and also in the managing its operating expenses and effective purchase, managing the cost of goods sold, which indicate everything related to profitability or operational profitability. Again, if it is decreasing, it's a warning sign to the company or to the management to see or to review where this decrease is happening, whether it is in the cost of goods sold or in the operating expenses or it's in the product mix or it is related to the pricing. So if it is declining, again, definitely it's a warning sign or a red indicator to the company to review its performance, especially in the operation and in the cost of goods sold. Then the net profit margin. Net profit margin, obviously, it's a final layer. The first layer what we discussed is cost of goods sold. When it's come to second layer is operating profit and the third layer is net profit. The net profit is the amount remaining in the company after covering all the expenses. It's also called net profit margin or bottom line measure. It reveals the percentage of revenue left after all the expenses, including cost of goods sold, operating expenses, interest, taxes, non-recurring item. Everything has to be considered in the net income. Again, if there is any irregular income, also has to be considered in the net income. So the net income margin or net income is the final profit that available to distribute to the shareholders. Again, net income profit margin is measuring how effectively the company is managing all these expenses, including the cost of goods sold, operating expenses, other administration expenses. Everything will cover in the net profit, and that net profit margin or net profit we are comparing with the sales to see what percentage of sales company retaining as its net profit, and that can be distributable to the shareholders. So let's look into this example. In this example, the operating profit is 800,000 and there is an interest expense 100,000 and there is a tax of 175,000. So in this example, net income is 525,000. So how we will calculate the net profit margin? So as we already discussed in the previous example, the sales is 5 million. So the net profit margin is 525 divided by 5 million. That is 10.5%. Which indicate that this company is retaining 10.5 cents in the asset of net profit in the company for every $1 of the sales. So again, this 10.5 or 10.5% is the net income that is available to distribute to its shareholders as profit. So let's move into next margin, that is EBITDA margin. Again, EBITDA margin, that is earning before interest and tax, depreciation and amortization, it's a proxy of cash operating cash expenses or operating cash flow, which is removing or which is avoiding interest, tax and depreciation from the profit, or it's adding back with the profit to see how effectively the company is managing its EBITDA. Again, it's considering only the cash expenses. That's why it's add back in its depreciation and amortization to net profit to remove that effect. Again, it's often viewed as a proxy of company's operating cash flow from generating cash flow generating ability, ignoring non-cash charges and their financing transaction decisions. Again, is purely related with the operation, how effectively the company is managing its operations. If EBITDA is better, which indicate that the company is effectively managing its operation and its operation expenses, excluding the depreciation and amortization. Again, the depreciation and amortization is not related with the operational expenses or with the pure operational decisions. So with the EBITDA, the company can effectively evaluate the operational effectiveness of the company to see how effectively the management or the operation department is handling its operation, and also how effectively they are managing their cost in terms of generating revenue and in terms of generating more profitability. The EBITDA, the formula is net income. If you already calculated net income, you have to add back the interest expenses. Why? Because we already reduced all these from the net EBITDA to calculate the net income. So to reverse to EBITDA, we have to add back all this, like the interest expenses, taxes, depreciation and amortization. We have to add back to the net income to calculate the EBITDA. Again, EBITDA is mostly useful to compare the performance of two companies which is efficiently or which is operating in the same segment, especially if the company is with a high capital intensity in especially the manufacturing and telecom, where depreciation policy can vary widely, skewing EBIT. So in the high depreciation companies, if a company have high depreciation or it's highly capital intensive, the EBITDA is the best metrics to measure its core operational performance, because it is excluding non-operational activities, also the depreciation. Again, the depreciation, when it comes to depreciation, it's not a decision with the operation department, it's a decision with the finance or the strategic decision with the top management. So the EBITDA, they cannot influence the EBA, the operation department normally they cannot influence the amortization and depreciation decision. So that can be removed to measure the EBITDA. So it's an effective way or effective tool to measure the performance of the operations. So let's look into this example. In this example, the net income is 525,000 and there is an interest expense of 100,000 and taxes 175,000. Again, the depreciation and amortization 200,000. So to calculate the EBITDA, what we have to do, we have to add back all this 525 plus 100,000 plus 175,000 plus 200,000. So you will end up with 1 million. So in this case, 1 million is your EBITDA. So again, you have to compare this 1 million with your sales to see the EBITDA ratio. Just it is 1 million divided by 5 million, that is 20%. So which indicate that every $1 of sales or every, just as you say, every $1 of sales, this company is maintaining 20% or $20 as EBITDA in the company. So we'll move to next concept, that is return on invested capital. Again, the return on invested capital. This is to see how effective the company is generating return against its invested capital. It is very efficient to calculate the capital allocation efficiency, and also it's determine how effective the company is using its capital. Capital means debt and equity invested to generate the profit. This is a critical metrics for long-term value creation. So the formula for return on invested capital is non-operating profit after tax plus invested capital into 100. That means you are comparing the non-operating profit that available to equity, that available for investment divided by invested capital. So in this case, normally the return on invested capital, the investment mean which will consider both equity and debt. That means that is our total asset or that is the total investment. So with the return on invested capital, yes, the management can make a important decision, that is whether to invest or this investment is feasible or it can create some value to the company. It is very effective if we compare return on invested capital with the weighted average cost of capital. What is weighted average cost of capital? Weighted average cost of capital is the final cost of capital. That means if you have some equity, some debt, then what is the average capital cost for us? That is the weighted average cost of capital. So normally the company will compare return on invested capital with the weighted average capital to see whether this investment or this project is creating any economic value to its shareholders. Normally, if the company is generating more return than the weighted average cost of capital, obviously it is creating more value to the equity shareholders. If in the worst case, if the weighted average cost of capital is higher than the return on invested capital, so there is a gap in the invested capital, so that loss that is destroying its economic value. For an example, the return on invested capital, that means the company is generating a return of 10% for its invested value. Then the weighted average, if the weighted average cost of capital is 8%, just assume. If it is 8%, there is a remaining 2% here. That means the company is generating 2% more than its cost of capital or its return. It's more than 2% higher return than its weighted average cost of capital. So which indicate that this 2% will be a economic value addition to the equity shareholders. But in the reverse case, let's assume if the company is generating a return of 10% and its weighted average cost of capital is 12%. So in this case, this company is losing its value, destroying its economic value, because the company has to pay 12% as return on or weighted average cost of capital, but related to that investment, this company is generating only 10% of the return. So which is a value, which means the company is destroying its economic value while this project or this proposal is not generating an economic value to the company. So the return on invested capital is a key metric to see or to measure the profitability of the project, again to decide whether to invest or to not invest in this project. Again, it is comparing, will help to compare the what is the return, expected return from this investment, and also what is the capital cost for this investment. So this comparison will be very meaningful if the company is making investment decisions. So this is about today's discussion. So we are just going to conclude our discussion, what we discussed today. The first one is gross profit margin. It's very simple. Gross profit divided by the revenue. That means it's comparing or it's analyzing the pricing power and its production or its purchase cost. Then the operation margin or operating margin. Operating margin is comparing or is analyzing the company's core operation or operational efficiency, management efficiency in running the business. Then when it's come to net margin, net margin again is the bottom line or profit retained after all the expenses, which indicate that how effectively company is managing all these expenses, which cover the cost of goods sold, operating expenses, and all other administration expenses, how effectively the company is managing and generating the net profit margin. Then the EBITDA margin, it's mainly for the industry-wise comparison or to see operating cash flow generation, useful especially for the cross-industry comparison. Then the return on invested capital. Return on invested capital will help the companies to compare the cost of capital and the expected rate of or expected return from that capital to see the investment proposal or to evaluate the investment proposal and to analyze whether a current project is generating an economic value or is destroying the economic value to shareholders. So this is about today's discussion. If you have any doubt or you need any extra clarification on any of these topics, please ask me on the comment section. Again, I am attaching this PDF document along with this video. You can download and refer this material. Thank you for watching this video.